Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, October 31st, 2021. Wishing you a very happy Halloween. We've got another great show for you this week. We've got members of the media, academia, and financial services standing by as we're set to analyze all the news in retirement markets, technology, personal finance, so much more. So sit back, relax, enjoy this episode of BRN Sunday. We're going to kick things off with a look at what's going on Capitol Hill, and quite a bit these days. Joining us to break it down in the smooth way that they always do. They're known as the Legal Eagles, but they're also known as David Levine and Kevin Walsh. Both are principals with Groom Law Group, an employee benefits law firm based in good old Washington, D.C. Gents, great to talk to you. Thanks so much for joining us this morning.
Thanks for having us, Jeff. You know, the smooth, dulcet tones, we got to keep those going on a Sunday morning.
Absolutely. And I should say happy Halloween. And are you all dressed up early this morning?
I've decided to dress up as a podcaster.
There you go. And how about you, Kevin?
I'm totally in costume at this point. You know, I'm trying to be a superhero, saving the retirement system, you know, protecting it from, you know, potential changes.
There you go. Well,
all right. Wait. So that means, just to make sure I've got this clear, Kevin. So you're wearing a pocket protector, glasses with tape, and your Revenge of the Nerds movie is streaming on your phone?
Yeah, I look exactly like Clark Kent.
Exactly. All right, sorry. I don't think Jeff wants to hear that.
No, I like that. I think the audience always wants to hear how the Legal Eagles dress when they're not on the program. All right, guys, let's start with you, Kevin. Budget reconciliation. We have been talking about this bill for the last few weeks, months, whatever the time frame is. What's the latest here?
So we've been talking about the bill for a while because, you know, in early versions or in recent versions even of the reconciliation package, which is the Build Back Better bill, we had seen, you know, proposed changes related to, you know, credits for retirement savers. We'd seen proposed changes related to essentially mandating that certain employers offer plans. And we'd also seen, you know, pretty significant provisions that would have you know, taxed a number of IRAs or limited the investments that individuals could make in their individual retirement accounts. And these provisions had garnered a lot of attention. Now, they'd garnered attention in our space, but, you know, the Build Back Better bill, initially it was talked about as a $3.5 trillion package. The version that the president released yesterday that appears to have support in the Senate and that appears to have support from Speaker Pelosi is down to a mere $1.85 trillion, and I say mere kind of in jest. But so the big news there is that if the version of the bill that the president, you know, indicated he supported and believes is the deal that's been struck, ends up being the bill that is ultimately enacted, then the retirement provisions will not be included in Build Back Better. And that, you know, some of the provisions, the additional credits may be, you know, beneficial to some retirement savers. Some of the provisions like the employer plan mandate could have kind of mixed views depending on where one is in the retirement space. And then kind of the changes to the IRA system had garnered a lot of concern because in some ways they seem to be, you know, unwinding the deal that was made with individuals when they saved in an IRA, that the government wouldn't come back and you know, mess with it. So, I mean, I think on the whole, the retirement system is in a slightly better place, being a part of the current version. But, you know, I keep saying the current version. So I think it's important that we look at the landscape. And the landscape is that, you know, Build Back Better it's a priority for Democrats. It's a higher priority for the progressive wing of the Democratic caucus than it is for the more conservative wing of the Democratic caucus. Mm-hmm. The progressive wing would like to see a larger bill. There's a second bill, which is the bipartisan infrastructure package, which in Wonkland we call it the BIF. And the bipartisan infrastructure package is a bill that, you know, has support of moderate senators. It's actually already passed the Senate. And now it's just kind of waiting to get through the House. And the House Progressive Caucus has made clear that they are going to block passage of the bipartisan infrastructure package until there's an agreement to pass a version of Build Back Better that is palatable to them. So these two bills are tied together closely. Yesterday, or not yesterday now, but on Thursday, the president and Speaker Pelosi really made an effort to have the bipartisan infrastructure package pass the House. All day on Thursday, Speaker Pelosi was saying that a vote was going to occur on Thursday. That vote did not occur, and it did not occur because the progressive wing of the Democratic Party has indicated that they still would like to see some changes made to Build Back Better. They would like to have a stronger commitment from moderate senators that they will support Build Back Better, even if the bipartisan infrastructure package passes. And so, we have this new framework, which the president released, and we have legislative text now on Build Back Better, and it suggests that the retirement system's out, as I described. But to use a cliche, it ain't over till the fat lady sings. And while we're beginning to hear some jazz as they warm up, there's some probability that changes will be made, and that possibly the retirement system won't be spared the way that it looks like it's being spared today. David, do you want to chime in?
Sure. There is one comment for our fans in Mudville today. That is,
why are our fans in Mudville today? I thought we were out. Is this disappointing news, David?
Well, Casey is still at the bat, and given we're using baseball today, there is one provision that's in there as of this moment relating to IRAs. They could have an impact on rollovers of business startup IRAs. There's this one provision that is still, I think, hanging out there. Am I wrong, Kevin, on that?
Yeah, there's the one provision related to discs.
Yep.
Discs.
And
Exactly.
I'd love to explain what discs are.
Please.
But when I read the bill yesterday, I had to look it up on Wikipedia, to be honest.
Yeah.
So if we want to do a segment on discs, it's going to have to be next week, or it's going to have to be David.
I was thinking we've already spent enough time. We could talk about and seeing what survives next week. Maybe we could touch on it then. But I had to mention there's one little piece of retirement still there, but it does not affect the vast majority of folks in the retirement community.
Yeah.
But it was worth mentioning.
Yep.
But on that note, there is otherwise joy in Mudville tonight.
There is joy in Mudville, and you're really dating yourself and myself and all of us about Casey at the bat. I'm not sure that a lot of people who are a lot younger than us even can know what that is, but that's fine. David Levine, Kevin Walsh, really appreciate you breaking it down, and we like to have a lot of fun doing this because it can be kind of wonky, and these guys do a great job. Enjoy the rest of your weekend. Enjoy your All Hallows Eve, and we'll talk to you again next week.
Have a spooky Sunday.
Thanks, Jeff, and enjoy trick-or-treating, listeners.
Thanks. Bye, guys.
Bye.
Welcome back. Now time to talk a little technology. Joining us on the line, he is lead advisor, executive producer for 7 Investing, Daniel Klein. Dan, great to talk to you. Thanks so much for joining us this morning.
Good morning, Jeff. Welcome to my metaverse.
Okay. Well, I think last time we chatted about a potential name change for our friends. I don't know if they're friends, for the folks at Facebook. And that has now taken place. The name of the new company is going to be Meta, M-E-T-A. And Dan, I'm going to get your reaction to this. Has your reaction changed since last week?
No. So the name is even stupider than I thought it would be. One, I don't understand the benefit of changing names. We talked about this last week. Every time you write about Google, you have to make some parenthetical that it's actually Alphabet. And in the case here, it's the overall direction I have a real problem with. So what is Facebook doing? They are changing their focus to the so-called metaverse. What is the metaverse? I think the easiest way to explain it would be to take a game like Roblox. So Roblox is an immersive game that kids are in, and maybe there's a concert in Roblox. Maybe they're having I don't know what you'd call it for an older kid, but a play date with a friend in the Roblox universe. Facebook believes that's the future, where, look, do I think there's going to be some applications of this? Yeah, I think the virtual boardroom, when the technology is good and we can all feel like we're in a meeting room together and do breakouts and have that, and it feels like we're in the same place, and the headset doesn't weigh 15 pounds, I think that's going to be great. But I'm not sure that Mark Zuckerberg, who as a billionaire who was perhaps a little bit odd before he was a billionaire, I'm not sure he's the right guy to know where humanity is going. And I've seen sort of no major interest from the public at large to go into this like Ready Player One world where like we all sit with headsets on all day. Again, there will be business applications, there will be healthcare applications, there will be gaming and fun applications. But pivoting your entire company to this seems to be like a terrible idea, though it's done a really good job distracting from the other problems at Facebook.
Yeah. Look, I think a rename. Look, companies are known for what they produce, regardless of the name of the brand, and I feel like it's kind of a dodge. That's just my personal opinion. It feels like a dodge in my book. Like, hey, we're trying to get out from under. We're not just a social network anymore. Now we're working on this metaverse, which, by the way, is from a sci-fi book from 30 years ago. That concept, right? And I know they're doing a lot of hiring around this. I think they're hiring 10,000 people in Europe, but I guess I just don't understand the name and. Dan, what's in a name? I mean, you're Daniel Klein. I'm Jeff Snyder. This is BRN. You're Seven Investing. What's in a name?
Yeah, I've changed my name to an unrecognizable symbol that you can't pronounce. So that's been really tricky on my license and my passport. No, just kidding. I don't know if you remember when Prince did that. I was in college. Well, we were probably both at Hofstra at the time, and they sent us at the Hofstra Chronicle a disc with that symbol, so you could add it to like your PageMaker files for your newspaper, which of course, like everyone else, we just called him the artist formerly known as Prince. Everyone is going to call this company Facebook unless the metaverse is a success in their vision of it. And here's the reality. If the metaverse became the dominant product for Facebook, then a name change would make sense. If, we joked about the Pizza Hut name change, but if Pizza Hut introduced burgers and burgers all of a sudden 10 years from now were their dominant food and they changed their name to Burger Hut, it would make sense. But changing it preemptively, like if you want to, declare that you're something bigger, call yourself the Facebook group, give yourself a name that implies you're more than one thing. And Facebook is more than one thing. It's WhatsApp, it's Instagram, it's a lot of different products. But aside from Facebook and buying Instagram and WhatsApp, I'm not sure Facebook has done a good job creating any products. Since they've owned Oculus, which is, by the way, no longer called Oculus, it's now their devices are called Meta. Those have not even been niche successes. They're pretty cool, but nobody actually wants them. So I have very, very little faith in this. And, good for Mark Zuckerberg spending billions of dollars on something that isn't a self-indulgent trip to space. Not that I don't think there's huge benefits that are going to come out of these space companies, but this is a giant pivot that doesn't need to be made. And I don't know, this feels to me like one of those, like, I don't know, if I ever do a Worst Ideas Ever 2, this is probably going to be one of the lead chapters.
Yeah, I mean, it's really self-serving, and I guess the brand people always make out really well, the people who come up with the names and all that kind of good stuff, and the rebrand. All right, Dan, let's shift gears because let's talk AI-powered drive-thrus. McDonald's and IBM partnering to make this, bring this to the McDonald's restaurants. Interesting. I think we've talked about Taco Bell enhancing its drive-through process. So what do you make of this? I think it's cool. Hopefully the food gets better.
Yeah, so McDonald's has actually been doing this a while. They bought a software company, I apologize, the name escapes me, a couple of years ago. And it basically allowed it to use things like traffic patterns and weather and time of day and all sorts of information to sort of do a smarter version of do you want fries with that? The reason they ask do you want fries with that is you get one upsell opportunity and they basically train you what's the one that's most likely to work. And a lot of people who didn't order fries probably actually want fries. They're just a little embarrassed about it. So if you say, do you want fries with that? I can just say yes, and it's easier. Well, AI can make that better. They can basically say, hey, it's 96 degrees in Florida today, and our AI determines that a lot of people are going to want a shake, even though they're not going to say it, or maybe even remember that we have shakes. So this can get really smart eventually. And I actually once talked with an exec from, I want to say Chick-fil-A about this. in theory, Chick-fil-A could facial recognition you, know your order, know what you want, but they made a conscious decision not to do that because it's creepy. So this is McDonald's doing this on an aggregate basis. They're not saying Jeff Snyder wants an apple pie with his Big Mac and whatever. They're saying people who make this order, who look like this at this time of day and this. When I say look like this, I don't mean appearance. I mean just general data makeup. This is what they want. And that's going to get better and better and better. And look, anecdotally, as someone who used to run a store, I kind of always knew what like a customer would want, like what you could add to their order. You know, guys buying a model, not that hard to sell them some extra glue. This is just the computer version of that, taking it to the next level. And look, I think every smart company is going to do this. But then on the other end, there are going to be some companies that actually sell the fact that they don't do this. I talked about this with automation, that if everybody automates their checkout counter, a good selling strategy for a local store, for a more folksy business, is to say we have people at our checkout counters. So I do think in a few years you're going to have companies like maybe a Chick-fil-A or maybe you know a Five Guys or some of your higher end places saying, you know what, we don't use an AI. Our food speaks for itself. Like we don't have to ask you if you want fries. You want our fries. But I do think we're going to see this across the mainstream of fast food pretty prevalently.
So let me get this right. I mean, this is really kind of an opportunity to upsell, right? So if you do you want fries with that, this is an opportunity to say, look at the data. And if someone also bought chicken nuggets and they bought a salad, offer it to them. And this is kind of what this is going to do. So it's really a sales opportunity. It's not really a consultative thing, right?
No, it's a way to do sales better. And we've seen, look, I've complained about this before. The Amazon recommendation engine is terrible. It doesn't tell you like, hey, you read this book, the sequel's coming out. Instead, it recommends like 50 books you don't want to read. This is doing that correctly. It's saying, okay, the person who orders 10 McNuggets, a Big Mac, and a large fry, and a Diet Coke, he probably wants a milkshake or an apple pie, but he's embarrassed to order it. So what if we offer him a promotion where it feels like he's saving money by buying an apple pie, even though his order goes up? Then he's not ordering an apple pie he doesn't need to eat. He's doing something fiscally responsible by getting an apple pie for half off or whatever the data is. So it's all about sort of crunching the numbers and figuring out what the best makeup is. And we talked about this with Starbucks. Starbucks might make more money when you go in and buy a plain coffee than if you buy a Frappuccino that takes somebody 5 minutes to make. That I'm sure there's a delta for that, but they have an entire system of incentivizing you to buy the things they want you to buy at different times. There's a reason you can get free refills of basic coffee because it basically costs them nothing and the profit margin's really high and it isn't hard to make. So you're going to see all sorts of ways of manipulating your order to benefit either what they have, what they need to sell, what they think they're going to make the most money on. Look, my son works part-time at Wendy's, and if you're getting to the end of the day and maybe you only have like 4 chicken sandwiches left, you probably don't want your AI to be, talking people into buying chicken sandwiches.
Yeah, well, I could use a chicken sandwich right now. I'm actually pretty hungry. Dan, let me ask you a question. Halloween is here. What are you dressing up as, and what's your favorite holiday candy?
So I'm a big Milky Way guy. I think that's I like the Score bar as well, but I'm going to go the classics and say the Milky Way is probably the consistently best holiday candy. But Jeff, here's the weird thing. Aside from like adults and like parties, which have largely been muted this year because our big downtown Halloween festival is only running on sort of a limited basis because of the pandemic, Halloween's not a thing all that much in Florida. Maybe if you live in like more of a neighborhood though there's lots of kids in my neighborhoods. I don't expect any trick-or-treaters. We do have some candy in case they come. I like to dress, and I'm not going to dress, but I like to dress as an obscure character that you figure out who I am by like looking it up later. So I would go as Mocula from the Stanton Optical commercial. So he's sort of a cross between an eccentric Elton John and Dracula that is a sort of reverse spokesperson for eyeglasses. And I look a lot like him in general anyway, so it would be a pretty easy costume. You get your like Elton John velour suit, your big glasses. No one would know what the hell I was, but they would know I was in costume. But sadly, we will not be going anywhere. It's also way too hot to wear like a velvet suit.
A velvet suit. I'm trying to picture what that looks like. Anyway, Dan Klein, always great to check in with you. Thank you for sharing your Milky Way Halloween candy selection, and also thanks for diving in, I should say, on the metaverse and drive-through AI. Have a great rest of the weekend. We'll talk to you again soon.
Thanks, Jeff. I'll talk to you next week.
Bye. Welcome back. Now we're going to talk a little real estate. Joining us on the line, he's a real estate reporter for Dow Jones Market Watch. Talking about Jacob Passy. Jacob, great to talk to you. Thanks so much for joining us this morning.
Glad to be here.
And I should ask you, before we get started, happy Halloween. Let me say that. And what's your favorite Halloween snack, Jacob?
Oh, good question. Well, I'm one of those weird people that actually does like candy corn. So I'll say that because everyone else's candy corn is left over for me.
Oh, there you go. You're okay. Well, it's always good to be a little bit of a contrarian.
Yeah, exactly.
And I like a little candy corn too, although my favorite is the Kit Kat. All right, Jacob, let's talk a little real estate. What's the latest here? I know with you. We talk mortgage rates. We talk supply chain issues. We've talked so many things in and around the real estate marketplace. What's the latest from the folks at MarketWatch this week?
Yeah, so I did a story this week on a study that came out of First American Financial. They're a title insurance company, and they do a monthly, what they call real home price index. So they kind of tie this to, this week also the Case-Shiller home price index came out. So there's this kind of like a kind of different spin on home prices. And so basically what they tend to look at is what they mean by real home prices is they put the home prices in context. Because when you see, Case-Shiller, this month again, home prices, continue to rise across much of the country, although notably, not this month, it was, the report actually from August because it's 2 months delayed. But the most recent report showed home prices were still rising, still at record levels across all the country, except the rate of growth had slowed quite substantially from the previous month. So prices aren't falling, they're still rising, but rising at a slower pace, which is kind of what we've come to expect because, the market's been cooling a bit. And also home prices follow kind of mortgage rates. There's a relationship there, and mortgage rates have been rising. So when mortgage rates go up, home prices won't go up as quickly because, mortgage rates kind of make the whole purchase more expensive for folks, and therefore, they're less willing to pay a higher price. But anyway, the First American report looks at home prices, in context, and the context they look at is they put it into context with mortgage rates, but also with wage growth. They're looking at how home prices are rising in tandem with wage growth or mortgage rates to get at, how much more or less affordable buying a home actually is. And basically what they found is that affordability had worsened significantly as of August because of, basically home prices are rising. I mean, the nominal home prices are increasing quite substantially, but mortgage rates, are, as of August, were kind of flat. So they weren't dropping to, kind of counteract that home price growth. And wages, while higher, had not increased enough still to, overcome the nominal increase in home prices. And then the most interesting part of this report, though, beyond looking at, how affordability is worsening, because I think we kind of have a sense of that, is they talked about how we're looking at what could be potentially a monumental shift in the housing market. And when they refer to it as the end of a 40-year tailwind. So for the past 4 decades, basically, the long-term trend with mortgage rates has been mortgage rates dropping. Mm-hmm. Obviously there's fluctuation in there. They'll rise for a few weeks and then fall back down. But, if you look at, if you take the Freddie Mac mortgage rate report, and you look at the graph since the 80s, it has been, a downward slope. But there's tons of indications, and you and I have talked about this too, that mortgage rates are going to actually start to rise and start to rise quite significantly. And that's for, a number of reasons. One, inflation is just going to be higher. And, it seems increasingly clear that, this isn't a short-term trend, perhaps with inflation, that, higher inflation is going to be around for, maybe a few years or so. We still got lots of, demand issues causing supply chain issues, et cetera. So, inflation seems to be here to stay, higher inflation that is. And also you've got the second trend of what the Federal Reserve is doing. And it's becoming increasingly clear that the Federal Reserve is going to back off and start to taper its asset purchases. Mm-hmm. So during the beginning of the pandemic, the Fed started purchasing assets, including bonds and including mortgage-backed securities, to pump liquidity into the economy and keep the grease the wheels, so to speak, when the pandemic was happening. And that had a huge impact on the housing market, because mortgage lenders, when they suddenly saw this massive wave of liquidity from the Federal Reserve, that's what helped them to justify dropping the rates as low as they did. But now that the Fed is, they're meeting in, I think it's next week, and, we'll get the news out of that meeting and see if they are going to actually start to taper in November or December. But it's pretty clear that's probably what's going to happen. And, if that does happen, mortgage rates are going to have to go up, because without that excess liquidity in the market from the Fed, mortgage lenders are going to have to rely on higher rates to, fuel their businesses. So mortgage rates are going to go up, but for the past 40 years, they've been going down. And that's, a potentially huge shift, because if we think about a realm in which mortgage rates are on an upward trajectory for an extended period of time, then that's going to change the calculus quite a bit for home buyers and existing homeowners. You're not going to see, obviously, as many people refinancing for lower rates. You might still see people refinancing for other reasons, but that's going to cut down on that activity. And you're going to see, home buyers be a lot more hesitant about higher home prices. So it's going to certainly temper, most likely, if this comes to fruition, temper home price growth, but it's also going to create real affordability challenges. And, as First American put it, it's going to come down to whether, incomes continue to grow and wages continue to increase enough to offset that trend. Otherwise, there could be some trouble for the housing market in the next couple of years.
Yeah, I was going to ask you the first thing. There are so many headwinds for first-time buyers, Jacob, that we've talked about, from non-availability to not having a home, to trade in or convert the equity into another home. So there's a lot going against them, and this seems like yet another headwind that you seem to indicate. And that really is not on the side, if these rates are going to go up, that is certainly not on the side of home buyers in general, but certainly not first-time buyers.
Totally. And for a very long, for 40 years now, basically, buyers, whether you're a first-time buyer or, you already own a home and are looking to, either, move up to a nicer home or downsize. Maybe you're an empty nester and you're looking to downsize. You could kind of always count on that tailwind, that push of lower rates to help make it all work out financially a little bit easier. But, in the next year or two, that's not going to be the case. And suddenly mortgage rates are going to become an impediment, not an aid, if these trends come to fruition. Obviously, let's keep in mind that, housing economists before the pandemic we're predicting this exact same thing, that mortgage rates were going to start creeping upward. Because since basically the 2008 crisis, they've fallen so low, to levels that are, would have been unthinkable back in, the 1980s when there were double-digit mortgage rates. So, I think economists have always just assumed that eventually it's going to climb back upward. So they could be wrong, but presuming they're not wrong, yeah, it's gonna create another impediment, and and then we get into a realm where we start having to worry about whether mortgage rates will not just be an impediment from people not being able to justify higher home prices, but then we could look into lock-in behavior. There's a theory among some real estate economists that low mortgage rates end up locking people into the homes they initially buy, because when they go to think about maybe moving up or downsizing, they suddenly look at it and they're like, well, the math doesn't work out because I'm going to be paying way more for a home, really, because not only am I paying perhaps a higher price for a home, but I'm also going to be paying a higher mortgage rate than what I have currently on my current home. And so that becomes an issue, especially at the low end of the market, in the, kind of entry-level home zone. A lot of those buyers may be disinclined to, move up to larger homes or bigger homes. Maybe they'll instead decide to just, construct an add-on or something like that, because they look at their mortgage rate and they're like, well, it can't really get much better than this. And so, there's that's been, that's a controversial kind of idea. There are some economists who support that idea. Some economists who say, no, people don't really care about their mortgage rate. Like if you have 4 kids in a 3-bedroom home, you're going to move up to a larger home, regardless of what your mortgage rate is. So, it's probably a bit of both, but, that's another issue. Is not only is it going to hurt first-time home buyers in the sense that they, won't be able to rely on cheaper financing anymore, but it's also going to hurt them because there's a significant chance that a lot of people who are already owning homes, who would maybe otherwise have purchased new homes, might stay in their current homes for longer because of their low mortgage rate.
Well, I think it's, look, there's always headwinds, and I think when you're buying properties, you always need to think about things long term. A couple of percentage points, or not percentage points, but half percentage points, probably not going to be deal breakers, but we don't want to get into the situation that I grew up in the 70s and 80s, which were really high inflation rates. That was detrimental to the economy, really contracted growth, et cetera. So I guess we're going to have to see how this all plays out. Jacob, always a pleasure chatting with you. Really, really great stuff. Really great having you back on. And we look forward to catching up with you next week.
Talk soon.
Thanks, buddy. Bye-bye. Welcome back. We're going to close things out with a look at the markets. And joining us, he is the lead anchor for the TD Ameritrade Network. You can find him on Markets on the Close and Morning Trade Live. We're talking about Oliver Rennick. Oliver, thanks so much for joining us this morning.
Jeff, good afternoon. Thanks for having me as always.
Absolutely. Let's talk, get your perception of what happened this week. A lot has transpired, a lot with this budget reconciliation bill that's going on. Build Back Better, or Build Back Better Now bill. But give us your assessment of the markets.
Yeah, that was a big development this week, is getting what seemed to be a fairly productive update on fiscal policy and the likelihood of agreement among Democrats to pass something to the tune of $1.7 trillion. That certainly is an important part of the story that is kind of uncertain on how its effect on markets will compare to stimulus we got last year. That's more the question, though, that is about what comes next and how the market responds to it. In terms of what happened this week and what's already transpired is big tech earnings and a fairly mixed response to the most important companies here for the stock market, but overall one that was positive enough to lift the NASDAQ 100 to a record and also push the S&P 500 to a record. So we've got records across the board in equity indexes, which is obviously a big deal anytime that happens. And leadership is very kind of mixed right now, where you've got the classic thing broken apart, where Facebook's well off the highs and Amazon is well off the highs. Apple is kind of struggling to maintain its near high elevation in its stock price, but Microsoft and Alphabet are breaking out. And we also saw some cloud names in their wake also post some very notable advances. We got a big move in Salesforce over the last couple of weeks. We've seen the cloud sector as a whole beating semiconductors, where that part of the tech market is still struggling due to supply chain issues. So the market has kind of picked a new set of winners that are still largely in the tech category, but are not quite as broad and monolithic as before, where it's not just the giants, but it's now broken apart some of that success in the big cap names. Tesla, obviously another big cap name that's breaking out. But the tech story is just a little bit more fragmented, but it's enough still at this point to carry the index when the index is also getting some help from some of the more inflationary plays that people are buying into, thinking about energy stocks. To your point about infrastructure deal, a decent little move in some of the industrial companies on Thursday after they had shown a little bit of weakness. So the market overall dabbling near the highs, but is doing so when some of the big favorites are definitely under pressure. It's just right now the math does not add up for bears when there are enough companies in that inflationary camp of energy and maybe some banks as well that are helping offset the tech stuff that is down. And the net result is a stock market at all-time highs.
Oliver, I want to get your reaction to this. We talked about it earlier in our program. Facebook rebrands itself as Meta, M-E-T-A. How does someone in your position kind of view that rebrand? Does it even impact the business news that you follow on a regular basis?
It's going to be interesting. I mean, you've never really seen a company this big doing what it's doing. I think a lot of people kind of are cynically looking at it as a ploy, a PR gambit to try and get themselves out of the negative spotlight. But I don't know, that falls short a little bit for me. It doesn't resonate a ton because Facebook's been in a negative spotlight from mainstream media and for basically half the population at least for a long time now. Mm-hmm. And that has never affected its ability to perform as a company. So, and it's a very fine debate, I think, philosophically to have about what they do, but it just has not really crossed over into the realm of the stock performance at any of these junctures over the last couple of years. Maybe it has in this latest pullback from the highs. It's very possible. In which case then changing the brand and changing the approach might make sense to some degree, but it certainly is a very different tone that we haven't really seen from a company with this much importance to the market before. So I don't know. It is just kind of a bizarre situation, and I don't really know what to make of it. Frankly,
oh, that's
the
fine.
stock seems to be liking it. It popped the last couple of days.
Yeah.
So it seems like the market is kind of into it.
Yeah, well, we're not going to put you on the spot. That's not our goal here. I just wanted to get your impression of that. And since you're a public personality, we don't want to put you on the spot. Oliver, one last question: when you look out into the coming week, what are some things that you and the network are going to be looking at on behalf of your audience that we should maybe be thinking about?
Well, we've got 10 minutes next week. That's going to be big, and we are looking for definition on the taper timeline from the Fed. The market knows it's coming. Inflation is meeting expectations while our economic data overall misses expectations. So that's not a good combination. The Fed needs to start signaling that it's aware of that conundrum that we're in. And they're going to set off on this taper as in an early kind of stage of doing that. So there's nothing more important next week than finding out if the timeline is going to be specific, if they'll give us something specific for the timeline.
All right, Oliver, the biggest question of the day, since it's Halloween, let me ask you, what are you dressing up as this for this Halloween, and what's your favorite Halloween candy? What is Oliver Rennick's favorite Halloween candy?
Mini 100-gram bars are very good.
Oh, yeah, that sounds very good. Are you going to be dressing up?
Not really. TBD. I won't wear my on-air clothes or whatever I'm doing this weekend.
Coming as the lead anchor. Well, here he is, the lead anchor. He doesn't have to dress up for this, folks, and he always looks spiffy. Oliver Rennick, lead anchor for the TD Ameritrade Network. Have a great rest of your weekend, and we'll talk to you again very soon, my friend.
All right, thanks, Jeff. All right,
bye-bye. Well, that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow for BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.